So, what are these so-called stocks that a lot of cool people seem to be talking about nowadays? Is that the new lingo? First, let me begin by giving you a general idea of how stocks work. Chance currently has a dream to open a sushi restaurant called Loving That Sushi. In order to make this dream happen, Chance needs to cough up $100,000. However, his savings account only has a sad face emoji and $10,000. So Chance does what any good friend would do and asks 9 of his close friends for money to cover the rest of the $90,000. In order to do this, Chance will need to split 90% of the company's ownership in stocks to his friends, which now means that the sushi restaurant is owned by Chance and 9 of his close friends. Each person owns 10% of the restaurant. Fast forward 10 years into the future, and Loving That Sushi restaurant is now worth $10 million. All because of this restaurant and their famous shrimp tempura rolls and amazing salmon avocado rolls, Chance and his friends now each have a wealth of $1 million. Business is booming. Please remember to give this video a like, or else Chance's sushi restaurant won't do so well in the future. Subscribing to this channel also gives Chance a lot of hope. So the brief and simple definition of stocks is that they are considered as a piece of ownership of a company. However, this doesn't mean you can actually sit on a CEO's iron throne. Companies issue shares to investors in order to raise additional funds. I just want to pause for a second and clear things up. I tend to use shares and stocks as interchangeable terms. They sort of mean the same thing, but not really, so I would put both definitions in the description below for your reference. Now, the reason why investors would buy company shares is so they could see their wealth grow. Stock prices appreciate and depreciate. In other words, shares go up and down. They fluctuate a lot. Remember these terms so when it comes time for you to teach your friends and family, you'll sound like a legit Warner buffet. Stocks are based on supply and demand. Always remember that. The more innovative, profitable, and reputable a company is, the higher the stock prices are. Meaning that investors who bought these shares at a low price are celebrating because they see growth. So always remember to sell high and buy low. But the opposite can be said if a company decides to make a bad call and start generating negative reputation. Stocks will go down and you'll see several investors start panic selling so they don't lose any profit or any money. Alright, so how do you as an investor make money owning shares? Well, remember that Loving Sushi example? Chance doesn't really have $1 million in his pocket or in his savings account. He holds shares that are worth $1 million, which means that if he wanted to actually cash in his gains, he could sell all his shares and have a gross income of $1 million, not net income. Net income is the amount of money a person makes after costs and deductions are factored in, also known as taxes and expenses. Gross income is the amount of money before any deductions are made. Remember, Uncle Sam is always watching you. Another way investors can earn money is through dividends. Dividends are a distribution of the company's earnings to shareholders, investors, or owners of the company. They are sort of a reward for everybody who invested their money into the company. Dividends can either be paid through cash or by earning additional company stocks. Most of the time, but not always, larger successful companies often give out the best dividends. They are paid either monthly, quarterly, semi-annually, or annually, depending on the company. The amount of currency that person gets through dividends is based on a per share basis, which means the more shares you own, the more money you're going to get back from that company. For example, Loving That Sushi gives 60 cents per share and his company pays quarterly. And let's say you happen to own 50 shares of his restaurant because you love his salmon and avocado roll. That means that every quarter of the year, you will receive a check for $30 for being a loyal investor. Now let's go back to the topic of stocks. According to Goldman Sachs, the average stock market return is around 9%, and with an inflation adjustment of an average of 2%, you're looking at a 7% return, which means that if you had invested $10,000 for 10 years on a company that had a record of a 9% return and no additional annual contributions, assuming that we have an inflation rate of 2%, you will be looking at a present value of around $19,000. Don't forget about taxes though. Now, I want you to remember this. Not all companies are the same, nor do they behave the same way every single day. Apple shares could be doing great today, but they could be going down tomorrow, thus making stocks volatile. It is recommended that you as a beginner build a well-rounded portfolio that includes stocks in many different companies. This is called diversification, when you buy stocks in not just different industries, but also different geographies, which means not only investing in technology, but also considering investing in oil and gas, utilities, healthcare and pharmaceuticals, banks, food, transportation, and real estate. Never ever put 100% of your money on a single stock or an investment, unless you know exactly what you're doing, or you just don't care about your money and scream out, you only live once. Warren Buffett, I'm not sure why I call him Warren Buffet, best investor in the world, believes that diversification is a protection against ignorance. So he's completely against it. However, he also states that diversification makes little sense for those who know what they're doing. So unless you know what you're doing, you should consider diversification. It's better to get your feet wet first and then dive into the pool of investing. Investing is risky, but well worth it. That's why the saying goes, the higher the risk, the higher the return. But risk can always be mitigated if and only if you start learning more about your own investments. Also by being patient and considering that investments are a marathon rather than a sprint. So some key takeaways from this video would be, nothing in this world is ever guaranteed, except taxes. Sell high and buy low. Create a well-rounded portfolio by diversifying your investments unless you know what you're doing. Always be patient. The longer you invest, the more of a chance you have of growing your own wealth. Definitely don't be greedy. Stocks will always fluctuate since they depend on supply and demand. Whatever a company is worth today will not be worth the same tomorrow. And always, always, always have savings for a rainy day, also known as your emergency funds. I will always emphasize this statement. If you made it this far and enjoyed the video, then please dale un like. It will not only help Chance's sushi restaurant, but also this channel. This will mean a lot to me. Don't be afraid of subscribing and also hitting that bell for notifications. Thank you for watching this video and I hope you enjoyed it. Always remember to be patient and never be afraid to take a chance.